Before April 2025, I had a clear answer to the question every investor eventually gets asked. What would you do if your portfolio dropped 20%? I would hold, obviously. And then the market actually dropped, and within days I had sold off over 5,000 Swiss francs of ETFs. Exactly what I told myself I would never do. And this is what it cost me, and why it will probably happen to you too, even if you're certain right now that it won't. Let me explain. In April 2025, Donald Trump announced a sweeping tariff package. Markets moved immediately. Over the following days, global indices dropped roughly 15%. My portfolio at that time was worth around 65,000 Swiss francs. And on paper, I had lost somewhere between 8,000 and 10,000 in less than 2 weeks. I want to be precise about what I was thinking, because I think it's more honest and more useful than just saying I panicked. I didn't feel panic exactly, I felt something more rational sounding. I started running scenarios. If the market drops another 15% from here, I lose another 8,000. So if I sell now and it drops further, I can redeploy at the bottom and come out ahead. So I had reasons. I had a spreadsheet open and I felt like I was managing the situation. The market had other ideas. I sold 5,000 francs of ETFs and I had around 20,000 sitting in cash. Money I had been meaning to invest for weeks. I chose not to deploy it. My reasoning was, if the market drops another 15%, I will regret having bought at minus 15%. Better to wait for the real bottom. Now, the market didn't drop another 15%. It recovered. Within weeks, it was back near where it started. I had sold into the drop and held cash through the recovery. Well, that's the story. And now let me show you what it actually cost. Let me calculate this properly, because the numbers are more uncomfortable than they first appear. The 5,000 francs I sold during the drop, I sold at roughly minus 15% from the recent peak. So the market then recovered to roughly where it was started and kept climbing. So if I had held those 5,000 francs through the recovery, they would be worth approximately 6,200 today. So 1,200 gone from my own decisions and not from the market. The bigger cost is the cash I didn't deploy, the 20,000 Swiss francs sitting in the bank account earning nothing. If I had invested it on April 9th near the bottom of the drop, and the market has since returned roughly 20% from that point, that 20,000 would be worth approximately 24,000 today. So 4,000 francs of return I didn't get. I was waiting for a bottom that never came, and the combined cost for both decisions were approximately 5,200 francs. That's not just a rounding error, it is really a significant sum. Gone from two decisions that felt completely rational at that time. And here's what still gets me. I knew better. I had read about this, and I had even talked about it. Knowing something intellectually and doing it under real pressure are completely different things. That gap between what you believe about yourself as an investor and how you actually behave when the money is disappearing from your screen is the thing almost nobody warns you about clearly enough. So here's the question I kept asking myself afterward. Why did I do something I knew was wrong? And the answer isn't stupidity. It's something more predictable. So when you're reading about investing from a position of calm, no money on the line and no red numbers on the screen, your brain processes it analytically. Of course you wouldn't sell during a crash, that data is clear. But when you're actually watching 8,000 francs disappear in 10 days, something different happens. Your brain stops processing the situation as an abstract financial question and starts processing it as a threat. The rational sounding scenarios it generates, if it drops another 15%, selling now is actually smart, are not analysis. They are your threat response dressed up in financial language. And this is not a personality flaw. Psychologists call it actually loss aversion. So losses feel roughly twice as painful as equivalent gains feel good. A 5,000 loss feels worse than a 5,000 gain feels good. When your portfolio is dropping, your brain is experiencing something closer to physical pain than financial inconvenience. And pain makes people act. The most dangerous moment in investing is when you know exactly what you should do, hold or even buy more, and your brain generates a compelling reason not to. And that's the moment I failed in April 2025. So based on everything I read, it's the moment most investors fail repeatedly without ever fully understanding why. And there is actually data on this. Dalbar, a US financial research firm, has tracked the gap between what the market returns and what the average investor actually earns since 1985. In 2024, the average equity investor earned 16.54%, while the S&P 500 returned 25.02%. So that is an 8.48 percentage point gap in a strong bull market from investors simply moving money at the wrong times. So the fund did fine, the investor didn't. So here are the 3 things I got wrong and what I know now, so you don't need to make those mistakes. So mistake number 1, I confused a 10-minute feeling for a considered decision. Selling 5,000 francs felt deliberate. I had reasons, I had scenarios, but if I'm honest, the whole process took about 10 minutes. Genuinely considered tactical thinking. The kind that would justify timing the market. Takes weeks of analysis and still fails 90% of the time. So 10 minutes of scenario planning during a market drop is a stress response with a spreadsheet attached. So I have a personal rule here. Any sell decisions made during market stress has a 72-hour waiting period before execution. If the reason still holds after 72 hours of calm, it might be legitimate. Mistake number 2, I waited for the bottom that doesn't announce itself. So holding 20,000 in cash, waiting for the real bottom sounds disciplined. But nobody knows where the bottom actually is. The bottom is only visible in hindsight, which is exactly when it's too late to act on it. Research from JP Morgan covering 20 years of S&P 500 data shows that missing just 10 of the roughly 5,000 trading days cuts your total return in half. Those 10 days almost always fall during periods of maximum uncertainty, when most investors have already moved to cash. So the personal rule, cash earmarked for investing gets deployed within 30 days of the decision to invest, regardless of the market conditions. And finally, mistake number 3, I had no written plan. Before April 2025, my crash plan existed only in my head. Hold and maybe buy more. That plan lasted for about 4 days before it evaporated. What I have now is a 1-page document. If the market drops 10%, I do nothing. If it drops 20%, I deploy 50% of my cash reserve. And if it drops 30%, I deploy the rest. Written when the market was calm. Signed in a folder. The specific percentages are not the point. The point is that a written plan made during calm removes the decision from the moment of stress. You follow your instructions you wrote when you were thinking clearly. So what does the long-term data actually say? Every major market crash in modern history has eventually been followed by a full recovery and new heights. The 2008 financial crisis, the 2020 COVID crash, the 2022 rate hike sell-off, the April 2025 tariff drop. Each one felt, in a moment, like it might be different, and each one recovered. So Pictet Wealth Management publishes a study of Swiss equity performance going back to 1900. Swiss equities have returned 4.6% annually after inflation over that entire period. Through 2 world wars, multiple depressions, currency crises, and every geopolitical shock you can name. And the specific number that matters for anyone with a 10-year horizon, according to the same Pictet data, a Swiss equity investment held for any 10-year period starting from 1931 or later has never produced a negative real return. Not once, through everything. The market does not reward the investor who timed it correctly. It rewards the investor who stayed. And here's what I would tell someone who wants to be prepared before the next crash. And there will be a next one. Before the market drops, write your plan. 1 page. What will you do at -10, -20, -30%? Sign it, put it somewhere you'll find it when you're stressed. When the market drops, read the plan and follow it. Apply the 72-hour rule to any decision that deviates from it. Now on cash, set a deployment deadline before the drop happens. Investable cash should be deployed within 30 days of the decision to invest it. Waiting for a better entry is the feeling of control without any of the results. And on checking your portfolio during a crash once a week maximum. The daily checking does not improve the returns. It increases the probability of acting on noise. The difficulty is psychological, and the only way to make it easier is to move the decision from the moment of stress and put them into a plan made when you were calm. If you want the one-page crash plan template I now use, the exact document with the percentages, triggers, and the deployment rules, it's in the newsletter this week. Link is in the description, and I will see you in the next one.